It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. China's first quarter GDP growth beats expectations, but retail sales for March missed forecasts, showing that consumers are still not stepping up. A resurgent dollar puts pressure on Asian currencies. The PBOC forced into a weaker yuan fakes. Bank Indonesia intervenes while yen traders bracing for intervention. And we have a great lineup of guests. Morningstar's global CIO Dan Camp is just ahead, and later we'll be joined by Crypto.com CEO Chris Mazalek. Let's take you to markets. Asian stocks under a lot of pressure. In fact, the MSCI Asia Pac index at session lows down almost 2%. Remember, the MSCI was down about 1% yesterday. It has to do with those U.S. retail sales numbers, CPI suggesting sticky inflation, pushing back on expectations of the rate cuts by the Fed. Treasury yields climbing, of course, overnight. 10-year yields at a new high. Year-to-date, 2-year yields flirting with 5%. And of course, it is about China. Data has been pretty mixed. The yuan weakness persisting. PBOC, by the way, surprising with a loosening of its grip by weakening the fix at the lowest level in about a month. Some suggesting perhaps the PBOC finally bowing to reality. Take a look where we are in terms of Q1 GDP, 5.3%, beating estimates of 4.8%. Now, as we said, a busy day for key data out of China. China's economy beat expectations in the first quarter, boosting expectations the government can meet its ambitious annual target of 5%. But more of a mixed bag in the March activity data, while fixed asset investment beat results for industrial production and retail sales both missed estimates. Meanwhile, China's new home prices showing a slight improvement in March from February, while still contracting for a 10th straight month. Well, we heard earlier from BlackRock Vice Chair Philip Hildebrand for his take on the Chinese data.
There is a lack of domestic demand. That's going to be a challenge going forward. The number probably came in roughly a little bit above expectations. You can see that global activity helps in support here. The policy stance helps, but over time the challenge is going to be this domestic demand problem, and of course the fact that China is really in deflation.
Let's get more analysis on China's economic data as well as today's swings in the yuan with Bloomberg Economics Chief Asia economist Chang Shu and Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chu, both joining us from Hong Kong. Chang, let's start with you. Strong beat on first quarter GDP, but disappointment elsewhere. What are some of the key takeaways? What does it tell us?
Yeah, the data today, certainly it contains some positives, but in the meantime, it raises quite serious question about recovery sustainability. So if you look at the data in detail, yeah, the beat is entirely driven by government spending. It's positive in the sense that the government has been more proactive compared to last year in supporting growth. So it can lift sentiment and drive initial momentum in recovery. However, it's not guaranteed that will turn into a self-sustainable recovery, because as we can see, the private sector has been very weak, production is very weak, and the demand, as reflected by retail sales, is pretty feeble.
So that 5% GDP target, which some say is pretty ambitious, is pretty much intact at this point in time, but nonetheless, more help, more stimulus needed from China.
Yeah, indeed, we do see going forward, the economy does need support, and certainly the government is going to support it. At this point, we see the support will mostly come from the fiscal side rather than the monetary side in the near term. I mean, fiscal stance, the government has been much more proactive than last year. We see fiscal spending in the first couple of months has been faster than the previous years. So that certainly can give the economy the much needed support. But at this point, PBOC's policy is somewhat constrained by the weakness of the yen. I think the PBOC has a renewed focus on the exchange rates. Previously, during a few years, it was less focused on the exchange rates, but now it's sort of going back to worry about the exchange rate again. That does constrain how much or when it's going to start cutting the interest rate again.
Let's talk about the yuan, Stephen. I mean, it does seem like the PBOC finally bowing to reality, the reality of a weak economy, weakest yuan fix in about a month.
Yeah, I mean, this is bound to happen. It's just a matter of time, just because the dollar is so strong across the board. Basically, firstly, because of a more hawkish Fed, now market pushed back the rate cut expectation. And secondly, we have the geopolitical tension between Iran and Israel. That's helping the dollar. So that's why the CNY against the dollar will have to be under pressure. Now, why the PBOC finally decided to lift the fix above 7.1, we think the main reason is because the yuan CFS basket is really too strong in their eyes. For example, if you base on the fixing today, the CFS basket is already at over 150. And then if you look at use the spot CNX to calculate the basket, it's above 99 this morning as well. So that's why, yes, the yuan may look weak against the dollar, but it's actually so strong against the other currencies, especially the euro, the yen in particular. So that's why, I mean, like China also cares about their exports and stuff. It's not just about the dollar, but they have to care about whether the yuan is weak enough as well against the rest of the basket currencies. So that's why.
I know it's really difficult to predict, but what really is the true value of the yuan? And, what do you see the PBOC doing from here?
I mean, to be very honest, like we have a fair value model, which is for reference, because the FX people, FX traders, they don't really trade to fair value. But right now we have a value that's just above 7, so that would be more like a fair value. But given the strong dollar, I think every kind of valuation doesn't work, not for China, but for every currency, basically. So now, as long as the dollar stays strong, we think the upside pressure for dollar China will be there. So that's why they will have to stay on guard, whether keeping the fixing at this level for longer, whether via state banks selling dollars. They just have to stay around to support the yuan until the Fed really cuts for the first time.
Chang, we talked about how the PBOC, the government, will have to take additional measures to stimulate the economy. When might that be? What might that look like?
Yeah, so in terms of the fiscal side, it's certainly ongoing. As I mentioned, the first couple of months, the government has been very clear about how they are going to support the economy. In terms of the monetary side, when is the PBOC going to cut the rates, given the constraints on the exchange rate side? Our sense that different scenarios. One possibility, as Stephen just mentioned, the PBOC waits until the Fed makes a move. Another possibility we look at is the ECB move. The ECB indicated that it might not wait for the Fed, and it's entirely decided based on the Europe development. So potentially, if the ECB makes a move ahead of the Fed, that makes the PBOC not, if he wants to make a move, it means that it's not going to be the first central bank to cut interest rates this year. So that potentially creates another window to move ahead of the Fed.
And Stephen, it is about that strong dollar environment causing massive gyrations in the Asian FX space. We saw how Bank Indonesia has intervened to support the currency after it breached 16,000 to the dollar. I think that is the first time since 2020. I mean, what kind of headaches must this be creating to central banks in Asia?
We actually put out a note this morning talking about this. And now it's very similar to last year, very similar to 2022. Now, basically across Asia, all central banks are facing intervention pressure because now we are at very interesting levels. If you look at dollar Asia path, for example, dollar Taiwan 32.5, for the Indian rupee 83.5, and then say for Philippine peso at 57. Now, these are the levels that central banks have flagged over the last 2 years, either intervened or talked about it. So now we are back to this level. So that's why we have to watch the Asian central bank's action. They're going to be more active this quarter to support the currencies.
Right. Not too long ago, they were talking about rate cuts. PI, case in point, no longer the case right now. Bloomberg Economics Chief Asia Economist Chang Xu and Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chu. Thank you so much for your insights. Let's get more reaction to China's economic data with Dan Kam, Chief Research and Investment Officer at Morningstar. We were just talking about that really strong dollar. How is that shaping, how you view your investments?
Well, that's a really good question because, of course, currency we know is very volatile. It's very difficult to predict. As Stephen said, it's more of a trading asset often than an investment asset. And so really investors need to think of it as a risk. But, of course, it also drives revenues. And the market can be a little bit slow to see through the impact of revenues and costs. So currency is important. We tend to think of it as a separate thing to worry about when we look at individual asset classes. But the rise in the dollar is on everyone's minds at the moment.
That's right. And the rise of the dollar putting a lot of pressure on the yuan and Chinese economy as well. How are you looking at it in the lens of today's data? Pretty mixed, but GDP exceeded expectations. Does it does it encourage you to put more money into China?
It was a little bit mixed, but it was better than expected, as you say. The thing to remember, and you know this about economic data, is always backward looking. And so what we know is that the first quarter was a bit better, and now we have to look forward as investors and see what lies ahead. And what we seem to be seeing in China is a bit of a emergence of more confidence among consumers there, and obviously the government is trying to promote growth because growth is good for China. And that looks like it's taking hold. And so that may be great for Chinese assets as people think again about the outlook for China and hopefully become less bearish. For us, we've had positions in large Chinese technology companies for the last couple of years following the sharp falls. We see some great value there, but it's still quite a small part of our portfolio for most global investors.
So when people made an exit from China, from the tech stocks in China, you made a bid for Chinese tech.
We were entering.
Which ones in particular and why?
Well, it's the big.
Is it just about valuations?
It's primarily about valuations. That's right. It's the big tech names, high quality tech names that viewers will have heard of. That my compliance people will insist I don't talk about. But people can imagine. So yes. So it's the large cap Chinese technology companies that we think are great businesses and suffered terrible sentiment. That's still ongoing in many cases, but we see good long-term business there at good valuations. And when we're thinking about investment, it's always about the quality of the business first and then the value at which you can buy it today.
So it's kind of like stock pickers market where you're concerned.
It really is.
What else looks attractive apart from tech in China?
Well, there's some good names around the consumer space as well. And again, that reflects valuations primarily. When you're thinking about real estate around not just China, the whole region, that looks very cheap, but of course there's some real structural challenges there, and so it would take a very brave investor to jump into that right now. But we're seeing some very low valuations, so there are plenty of opportunities. But as you say, when you're thinking about not just China at the moment, but the broader market, it really is much more of a stock pickers market than we've seen over the last few years.
The counter argument to your argument is that there are other markets. I mean, China is cheap for a reason, and people are saying take money out of China, put it in India, where you're going to see 8, 9, perhaps even 10% growth in the future. Why not?
Because things are always cheap for a reason. You never get things that are cheap without a reason, and the reason is always the same. The reason is sentiment, and sometimes that sentiment is valid. Sometimes it goes a little bit too far, and in China it seemed to us that it's gone a little bit too far. If you look at India, then that is a wonderful market. It's got a very rich set of good companies. It's, as you say, as an economy, as a nation, it's growing very quickly. It's a very exciting and vibrant place to invest. But we see valuations as being really quite high. We think a lot of that good news is already priced in. So the expected returns are lower than we're seeing elsewhere.
So the gains that we're seeing, the pace of gains that we're seeing in India is not sustainable. Is that a fair assumption?
Well, that's right. We would see India is pretty fully valued. So that doesn't mean it can't become very overvalued. That happens in the short term. It tends to suck in more money, more optimists. But from a sustainable long-term perspective, it looks expensive to us, and we think there's better opportunities elsewhere.
So in terms of China and India in your portfolio, can you give us a sense of how it's looking at?
Yes. So for global portfolios, of course, both markets are going to be fairly small for a lot of our investors.
That's under 5%?
So I would say with China, it's probably about 5%. That's exactly right. So it'll be small for most of our investors, but we would certainly favour China over India, and that reflects, to say, that valuation perspective. Now in India, with 30,000 listed stocks or thereabouts, there will be plenty of opportunities for individual investors. But if you're thinking about it from a market perspective, then we'd see more opportunities elsewhere.
All right, Dan, hang tight. Dan Camp, Morningstar, sticking around. Still ahead this hour, our exclusive interview with Crypto.com CEO Chris Malzlak. We discuss the company's expansion plans and the outlook for digital currencies. Plus, a preview of India's upcoming elections with political analyst Arati Jarath. All that coming right up. Keep it here with us. This is Bloomberg. U.S. data overnight suggesting higher for longer, even though Fed Williams did say that he expects rate cuts this year, but the timing remains that the uncertainty. And of course, we're talking about retail sales, CPI, beating expectations. VIX also, by the way, hitting levels unseen this year. We're seeing a surge in Treasury yields. Take a look at two-year yields right now, 492. It got to 499. It was just last week that we asked the question, when will two-year yields get to 5? We're not that far away from that level. And the jump in bond yields, a drag on tech, mega caps, and U.S. stocks. Let's bring back Dan Camp, Chief Research and Investment Officer at Morningstar, who says he's finding more value outside of mega caps. Yes, we've seen a massive run in mega caps. It's time to look elsewhere.
You really have, and yes, it is. Absolutely. So particularly the mega cap tech stocks, of course. That's been what's driving the market, particularly in the first quarter. The so-called Magnificent Seven of last year, which probably aren't seven anymore, but certainly they're driving the market. People are very enthusiastic. Where we're seeing the value is further down that market cap scale. We're seeing much better value in more cyclically orientated stocks, but particularly in some of the value areas of the market further down that market cap scale. So we may be coming into a stock pickers market for the first time in a very long time.
And a space you're very comfortable at. I mean, what have you been doing of late? I mean, if you take a look at, the overbought position of the Mag 7, I mean, where exactly are you looking at to pick up those stocks?
Yes, so we've got quite excited about some of those technology stocks about 18 months ago. We remember they were in the doldrums. People were concerned about rising inflation, rising rates, and large cap tech really sold off. So we saw, again, great businesses at good value, and we added to positions there. Right now, we are gradually reducing those positions in favor of smaller cap stocks, both in the US, but also looking at some of the other developed and emerging markets around the world. And if you look at what our equity analysts at Morningstar are saying, they're seeing the same thing. They're seeing a bit of overvaluation at the top of the market, plenty of opportunities at the bottom.
We're seeing surging yields. At what yield level will that weigh on stocks?
Well, I think you can see over the last couple of days, it's already weighing on stocks, and people were hoping for lower yields, lower inflation, lower rates this year, and now that very strong expectation from the last quarter has been confounded gradually at first, and then quickly over the last week or so, and now people are looking for confirmation of the new narrative that there'll be higher rates for longer. But in reality, we don't know what the next stage in the economy is. We've just gone through an extraordinary period that started with COVID and, of course, the recovery. It's been like one economic pulse that's moved through the economy. We don't know exactly what's going to happen next, but as it weighs on stocks, that, of course, hurts the current valuations for people, but it creates more opportunities.
2-year yields to 5, 5.5, even 6%. What are we looking at?
I mean, 6 seems very, very strong when people are still expecting rate cuts at the back end of the year. But 5, we're almost there, and it's been that sort of shocking last rise in the last few days. So when the market really gets behind a price or really gets behind a yield, then of course it can move very quickly, and momentum builds on itself. The key thing is to not assume that things will always carry on. As they move away from that fair value, it becomes harder to sustain that momentum.
So as far as you're concerned, no conviction when it comes to big tech. We have an M-Live question for the week, and that is, how will this earnings season impact big tech's momentum?
Oh, that is a very good question. So it depends on what the rest of the market is doing. So in that first quarter, we saw very strong earnings out of big tech, and what we saw last week with some of the banks was disappointment in the outlook led to very sharply falling prices. This is a market, it seems now, where investors don't like to be disappointed by earnings. So we could see both disappointment that comes through in any stocks drive prices lower. But of course, now that the large cap tech is so dominant, that really how they do against expectations will be really important. But like all companies, of course, they're hoping to beat by bringing back expectations going into the quarter end.
Dan, before we let you go, your conviction calls. What will make you the money this year?
Well, I think that the first conviction call is to look beyond the top of the market, move beyond this idea that it's all about geopolitics, it's all about the Fed. That's what's dominating our heads. But for investments, we need to look lower. Then, second, we're seeing more value outside the US. Some parts of emerging markets we've talked about, but also some parts of Europe as well, where we're seeing opportunities. So for all investors, cast the net really broad.
Stocks versus
and go
bonds?
deep. So stocks over bonds this year, but every basis point that bond yields rise, of course, they become better value, a better foundation for your portfolio.
All right, lock it in. Dan, thank you. Dan Kemp, Morningstar. Plenty more ahead. Keep it here with us. This is Bloomberg. Markets under pressure on the back of higher than expected data out of the US. Also data out of China. Mixed slew of data. GDP a beat exceeding 5% for Q1, but disappointing in terms of retail sales, industrial production. CSI 300 index under pressure, along with the Shanghai Comp, both down more than 1%. Shenzhen Comp down by almost 3% right now. It is about the yuan, currently at 723.68. Weakness persisting. PBOC surprising with a loosening of its grip by weakening the fix at the lowest level in a month. Some suggesting perhaps it is a true reflection of the Chinese economy. Overall, it is a red day pretty much across the board. Stocks, bonds, both under pressure. Currencies in particular, it is a strong dollar story, putting a lot of pressure, especially on emerging market currencies, the likes of IDR, Bank Indonesia intervening with the IDR surpassing $16,000 to the dollar. Still to come, Crypto.com CEO Chris Mazalek will be joining us. Keep it here with us. This is Bloomberg. Welcome back. We're taking a look at cryptocurrencies. Bitcoin up a tenth of 1%, 63,228 is the level we're looking at now. Hong Kong has given conditional approvals to several asset managers to start spot Bitcoin and Ether ETFs. That's expected to boost digital assets as well as the wider crypto market. The territory is competing with Singapore, Dubai, and others to become a digital asset hub. For more on competitive crypto market landscape, we're joined exclusively by Chris Marszalek, co-founder and CEO at Crypto.com, a cryptocurrency exchange with about 100 million customers worldwide. Chris, good to have you with us. First off, the pros and cons of doing business in Hong Kong.
Well, obviously, we are very pleased with the change in Hong Kong environment in terms of approach to digital assets. There has been a new framework that came out from the regulatory perspective, and this recent conditional approval of Bitcoin and Ethereum ETFs is a sign of a general support for the market development in Hong Kong. So we're quite pleased with it.
And how does Hong Kong compare to a market like Korea, for instance, where there is great interest in crypto among retail investors, and you're launching your app at the end of the month? How do you expect to do in a market like Korea?
Korea has historically been very difficult for overseas players to enter, and we've spent almost 2 years preparing for launch. It's obviously one of the largest crypto markets globally, with a very, very high adoption rate and extremely active retail user base. So we'll see how we'll do. We are in it for the long term. We've entered through acquisition of 2 licenses and a very prolonged product build out. So we'll do our best to provide a competitive product offering to Korean consumers.
But in terms of products and services, what can be expected after launching your app?
Right, we will give, our mission is to provide access to digital assets on a global level, and doing it in a regulatory compliant manner. So users in Korea can expect us to continue in this fashion, being the trusted place where they could trade crypto, and a good selection of it. Further down the road, we are very well known for our crypto card program. We are the largest Visa crypto card program globally. We will do our best to launch it in Korea locally as soon as possible.
Chris, I want to talk about the spot Bitcoin ETF. There was bigger than expected demand for it. What assumption are you making about appetite going forward and the long-term impact that may have?
I think structurally, it's a very good setup. You've got daily large-scale inflows, and this is against the backdrop of Bitcoin halving coming in a couple of days, which will reduce the supply side further. So I think structurally, this is well positioned. Obviously, Bitcoin and crypto right now in general is part of the global financial system. So we are not completely disconnected from what's happening in equities, for example, and what's happening with monetary policy or with what's happening in the geopolitical environment. So I think there's a general consolidation phase going on right now, which is similar to the previous cycles. And I expect pretty decent action within the 6 months following the Bitcoin halving.
Do you see any change in terms of the crypto market structure on the back of that nod to that ETF?
Definitely. Those are flows that were previously not present. So I would say that probably the proportion of Bitcoin prices being driven by retail activity or small investor activity versus institutions is changing during this cycle. And the things that we should look forward to is the decision making on Bitcoin ETFs and perhaps some other cryptocurrency ETFs, or even cryptocurrency basket ETFs in the future, because again, this may strengthen the flows.
Chris, you talked about that Bitcoin halving expected to happen in April. I'm just wondering how much impact that may have, given the kind of demand we're seeing for that ETF of late. Might that take away some of the impact?
I would say that this just improves the overall situation, because you've got less Bitcoin coming into the market that is being sold by the miners, and you're just cutting this in half. So it won't make a difference over a day or 2 or a week, but over a period of 6 months, it makes a substantial difference. So I think this is a net very positive development for the market. One has to always remember that there's this buy the rumor, sell the news kind of thing. So as we approach this date, there may be some selling coming out.
Right. And, we're seeing an easing of Bitcoin prices right now below 64,000 as we speak. I'm just wondering, do you see the rally continuing? What might lead Bitcoin higher from here?
Well, again, I think this is a period of consolidation. We've seen exactly this in fact happening in the previous cycles. So this is an asset that you want to hold for a very long period of time. You should measure it in years, if not decades. So I strongly recommend everybody who has this kind of time horizon to add it to their portfolio. And I personally expect great performance within the next 6 months.
In terms of your own strategy at Crypto.com, how does it look like for the next 6-12 months?
For us, this is all about scaling the size of the platform. We are approaching 100 million users, as you mentioned in the beginning. We want to hit 250 during this cycle. The retail intent so far has been muted comparing to the previous cycle. So it gives us this kind of notion that we are still early into, those are the early innings of the cycle. So it's all about scaling. And again, we've almost completed our regulatory licensing puzzle in all major markets. So we're ready to grow the business as fast as we possibly can.
At a time when we're seeing pretty aggressive strategies from Chinese exchanges, how might you counter that?
We have a completely different strategy, and we are building this business for it to last decades, right? So from day one, we've KYC'd every single customer on the platform. We followed very stringent rules regarding anti-money laundering. So this is our way of building this business. And we believe that if the market is supposed to reach 1 billion people, it has to be done properly on a sound foundation of regulatory compliance. So we pair this with pretty decent efforts in terms of brand building, because you want to be the trusted place for people to interact with cryptocurrency. So I think our strategy does not change. Some of our competitors that pursued somewhat aggressive tactics are now in hot water, and we are perfectly positioned to take advantage of that.
Chris, given your expansion plans and your long-term plans as well, I mean, what are your hiring plans on the back of that, and which markets are likely to drive growth?
Right. So we are hiring right now, but we're doing so very thoughtfully and strategically. We've got a couple hundred openings in the company outside of the customer service, which we scaled by about 700 people in the last couple of months. But outside of customer service, to meet the new demand and increase traffic, we are doing so very thoughtfully and strategically. Again, we want to make sure that we remain a very nimble, fast-moving company in this rapidly developing space, so that we can capture all the opportunities. We don't want to be, a very large, slow-moving corporate. That's just not how we want to build a company.
Any plans for sports sponsorship? Will you continue with F1, UFC, for instance?
Yeah, those are great properties and great partners that we have multi-year relationships with. I think we've already established ourselves as a globally recognized, trusted brand. We will again be very selective moving forward. Frankly speaking, not all of these partnerships move the needle for a brand like Crypto.com. So we want to make sure that whatever we choose to do is true to us and what we stand for as a brand.
Great stuff, Chris. Chris Maslach, co-founder and CEO of Crypto.com. Now, of course, we have a strong dollar environment, and on the back of that, the Indian rupee has weakened to a record low versus the USD. Of course, we had both the DXY and BBDXY at a 5-month high. Its 14-day RSI back above 70 for the first time since October. So not surprising, Asian currencies are under a lot of pressure. The Indian rupee weakening to a record low versus the USD. 83.5175 is the level we're looking. Let's get more on the weakness we're seeing across Asian FX today. Our MLive executive editor, Mark Cudmore, joins us now. Not surprising.
Yeah, absolutely has. And I know I'm always seem like I'm difficult, but this is really a dollar story. I think it's important. You got that headline, that arbitrary level in dollar India. The rupee is at a 5-month high against almost every G10 currency. It's outperforming most Asian currencies. You even saw on that screen we just showed there, it's gone through 83.50. The rupee is down 0.1% in the day against the dollar when the dollar is strengthening massively. It's about the dollar being at the 5-month high, exactly as you said. The rupee is still going to be a relative outperformer in Asia. We've had some recent good economic data. Of course, we've got the election come up, which is going to provide some uncertainty. But, we've had trade deficit data come through that's strong. It's world-beating growth. It is generally a good story. You get positive carry from it. I am still, on a relative basis, bullish the rupee. But you just don't want to hold it against the dollar in a strong dollar world.
But it's not just about the rupee. It's about emerging market currencies. Take a look where we are in terms of the IDR. Breaching 16,000, forcing Bank Indonesia to intervene. I mean, that weakness in emerging market currencies will persist. The yuan, case in point as well.
Absolutely, they're going to persist. And I think it's important you mention the yuan. So there's a couple of dynamics here. So first of all, strong dollar and higher US yields. That is not generally good for emerging markets. So that's the kind of core bit first. But the yuan policy is quite important around this. We know that the yuan is generally pegged to the dollar. So what we've seen today is the PBOC has allowed a little bit more yuan weakness. That basically means a shift lower in Asian currencies in particular. So yes, this is a tough environment for EMFX, but I actually think that these currencies, like the rupee, like the Indonesian rupiah, where the central banks are acting to defend them, they're going to be relative outperformers in such a world. In fact, in a strong EMFX world, they'll underperform. It's the same with the yuan, because they're lower volatility currencies and they are being defended. But on a relative basis, these are still quite good currencies. I prefer the rupee to the rupiah. I think the rupiah is a little bit more vulnerable, but I'm happy in that regard because I'm going to Indonesia next week.
And we're waiting for intervention in terms of the yen, and ain't coming, perhaps 160. We're talking about 150, 155, and now it's 160.
Yeah, I just don't see intervention happening anytime soon. I just don't
Not
see
even
why
at 160?
No, I mean, if we get to 160 quickly, absolutely. It's about pace. So if we're at 160 tomorrow, we're going to intervene. If we get to 158 tomorrow, we're going to be intervening. So I don't think it's about the level. But in this dynamic, where yields in the US are likely to keep on going higher. We've talked about this in the show in the last couple of months. I just don't see the Fed being able to cut this year. We're still pricing in almost 2 cuts from the Fed. That has to be a crisis coming through. So unless that crisis comes through in the US, the Fed will not be cutting rates this year, and dollar yen's going to go a lot higher. Now, if we get there too quickly, the MOF will intervene on the instruction of the BOJ to slow the overall gain in dollar yen. But essentially, if they whack dollar yen down, traders are going to be going, great, you've given me better levels to sell the yen again. Yen is going to keep on underperforming on crosses. You've got that slight kind of volatility risk. So if you're a short-term trader, it's not great because they'll intervene. But they'll only intervene on pace, so do not worry about levels. We could go much, much higher in dollar yen if we go there gradually. But if it's any sudden moves, the MOF will come in.
What's the biggest worry for the FX space right now? It's still about, is it still about the Fed and when it begins to cut? And how many cuts this year?
Yeah, well, I think if the biggest worry if you're an FX trader is, where's the volatility? It's been a bit boring at the moment. I mean, I'm not missing being not in an FX seat. It's the least exciting asset class. I think the FX volatility will return. We're starting to get rates volatility come back through. We're starting to see a pickup in FX volatility. I think that's going to persist. But you're talking about when will the Fed cut this year? I don't think they're cutting this year. I think that's a narrative. And so as a result, until we kind of get with that program, I think dollar's going to stay strong. I do think that ultimately, when we realize the Fed's not going to cut, actually it's not a dollar strong world. I think
Did I hear right? You're in the camp of Kashkari. No cuts this year.
Yeah, I've been there for months. Yeah, I think we're in a no-landing world. Ever since the Fed really ramped up the economy again by giving an extremely dovish message at a time when they're saying, we want to cut, even though the economy's strong. That was basically saying, we're in a no-landing bull market. And that is the story for 2024.
Ouch! MLive executive editor Mark Cudmore there saying no landing, no rate cut this year. Still to come. We discuss the key issues at stake in India's general elections with only a few days to go before the first ballots are cast. Keep it here with us. This is Bloomberg. India kicking off its trading day under pressure along with the rest of the region. Sensex, Nifty index, all under pressure, currently down about 0.7% each. But it is really about the rupee, Indian rupee at a record low versus the USD 83.53 is the level we're looking at. Now, staying with India, financing the world's most extensive electoral process remains a perplexing issue. Political funding through electoral bonds was scrapped by India's top court, but Prime Minister Narendra Modi is defending the move. Opposition parties accuse his party of using the instruments to raise funds from companies. Let's discuss this and more with Arathi Jarath, author, political analyst, and commentator. Arathi, your thoughts on those bonds?
There's been a long pending demand by opposition parties for transparency on these bonds because the main grouse is being that the donors are anonymous and, the public has no idea who donated what to which party. So now that, now that the genie is out and, we're beginning to connect dots, the picture that's emerging is quite disturbing, actually, for the ruling party because there seems to be a lot of quid pro quo between the companies that purchase the bonds and the political parties they donated those bonds to, mainly the ruling BJP party. And so this is obviously raising a lot of questions about this whole purpose of the bonds. The bonds were supposed to bring transparency into the funding process, but the funding process seems to have become much, much more opaque after the bonds, this whole bonds business started. So, of course, I don't know how much of an election issue this is going to be because, all these revelations have come just on the eve of the elections. And, the public really hasn't had time to digest the kind of information that's coming out. And the information is coming out very, very slowly. So, but
if you were to hazard a guess, Arathi, do you think the bond issue may impact Narendra Modi's and BJP's popularity in any way?
I'm sorry, I didn't hear you.
Do you think the bonds issue, which has raised a lot of questions, might impact Modi's and BJP's popularity in any way?
No, that's exactly what I said, that I don't think it will become an election issue because the revelations have come much too late. This order by the Supreme Court has happened just on the eve of the polls. And, the information is coming out in dribs and drabs. I don't think the voting public has had time to really digest the kind of information that's coming out, just to join the dots to, get the picture really. So I don't think it will impact the elections in any way. But, just in terms of, a system that was put in place on the plea that it would bring transparency to the funding process, well, I mean, it has just made the funding process much, much more opaque. And let me tell you,
Arathi, what's shaping this election? We know that BJP and Modi have been campaigning on the economy.
So there was a survey done by, one of the most respected surveyors in India very recently, which found that for most people, the price rise, that is inflation, and unemployment are the two key issues worrying them. And these two issues, although they figure in every election, they have never figured as strongly this time as, as they are. So I think that really the economy seems to be the key issue. The BJP was hoping that the Ram Temple in Ayodhya, which was inaugurated in January this year, that would become the, main driving force behind the election, the emotive issue. But unfortunately, that seems to have petered out. They've not been able to maintain that momentum. And, people's distress on the ground, that's really what seems to be surfacing now.
You said that the BJP may have lost momentum. Can it get to that 370 seats, which it is targeting? What does it need to do to get there?
they not only have to hold on to all the seats that they won in North India last time, which they virtually swept. So they will have to hang on to those seats, and they will have to make huge inroads into South India and East India, which to me looks like a very difficult proposition. The South has its own dynamics, and the BJP's attempt to kind of push this monochromatic Hindutva, as their main agenda, does not seem to be working very well in the South. And recently, as you know, the Congress won two big state elections in the South. So the Congress is pretty much, seems to have revived itself in the South. And the BJP is making a very big push, but it's going to be very, very difficult. So although it may get a majority, I think, this whole thing of 370 plus, 400 plus that they've been talking about, that really seems to be a very difficult proposition.
Arati, thank you so much for your insights today. Arati Jarath, author, political analyst, and commentator. Plenty more ahead. This is Bloomberg. It is risk-off in Asia. Asset classes pretty much across the board getting sold off on the back of that better-than-expected data out of the U.S. Inflation remains persistent, resilient. MSCI Asia-Pac Index down more than 2% right now at session lows, on track for the worst day in a year. Of course, we're tracking Treasury yields on the back of that. 10-year yields at a new high year-to-date. 2-year yields flooding with 5%, touching 4.99. Higher yields sending stocks lower, and we're suddenly seeing that here in Asia. It's also about data out of China, which has been pretty weak. It's mixed in terms of GDP coming in better than expected, but retail sales as well as in industrial production disappointing. The yuan weakness persisting as well. The PBOC surprising with a loosening of its grip by weakening the fix at the lowest level in about a month. Some suggesting perhaps the PBOC finally bowing to reality. Take a look at that. It is red across the board. Most benchmarks are down by about 2% across Asia. And in the Forex space is that strong dollar story. We've already had Bank Indonesia intervening after the rupiah slumped in excess of 16,000 for the first time since August 2020. In terms of the yuan, it is down about 1%, along with the Sing dollar also showing weakness. Take a look at where we are in terms of a bond yield surging in Asia. Pretty much the same story as what we saw in terms of treasuries overnight. That is it from Bloomberg Markets Asia. Daybreak Middle East and Africa is next. Keep it here with us. This is Bloomberg.